A non-traded REIT is an illiquid, a non-traded real estate investment trust. A public REIT that's listed on an exchange has more liquidity. The differences are that the publicly traded will act like the market and correlate with the movements of the market, and the non-listed REIT won't. It simply doesn't behave and doesn't correlate to the market. So it's an opportunity to own hard asset real estate without the movements of the market.
Part of the reason why you're going to get a higher dividend yield is the non-traded REIT has a tendency to pay out a much higher percentage of its modified funds from operations for dividend distributions, because you're not trying to necessarily grow the REIT as a result of capturing excess cash flow like you would in a traded REIT. You're really trying to grow the REIT as a function of raising new equity capital going forward.
The typical life cycle of a non-listed REIT is really comprised, in my opinion, of three parts. You first start with where you build the portfolio. You'll start with creating it, raising the capital, introducing it to investors, and raising a certain amount of money that you think is appropriate to adequately buy enough property, to maintain diversification, to gain the amount of exposure to that sector that you want to see. Then you're going to see the second part, which is you effectively manage it. The portfolio is stabilized, and you're looking to grow NOI and reduce expenses over time to really create as much shareholder value as you can. And then that third step is when you look to exit the portfolio, when you look to provide an opportunity for investors to either have a traded share, retain or have their investment returned to them with capital appreciation, or ultimately have stock in a different company that might otherwise buy that portfolio. So those three stages effectively can take a short period of time, which could be measured in a handful of years, upwards of 9 or 10 years. That's going to be dependent upon market cycles. It's going to be dependent upon the effectiveness of the management running that REIT and the investment strategy that's underlying it.
So really the goal when you start out is to get to a point where you are covering your dividend distribution with modified funds from operations. And then as a general rule, in the non-traded space, you're going to distribute a much higher percentage of the modified funds from operations than you would otherwise distribute in the traded REIT market.